Hello, everyone. So today we're going to talk about something that's been making headlines in the world of finance and energy. You might have heard it on the news or seen a headline online. Oil prices drop after Hormuz traffic resumes naturally. But what exactly is this, and why should you care? To start with, let's break down what we're talking about. The Strait of Hormuz is a narrow waterway that connects the Gulf of Oman to the Persian Gulf, and it's one of the most important shipping lanes in the world. It's through here that a huge amount of oil is transported from countries like Iran, Iraq, and Saudi Arabia to markets all over Asia. Now, when we talk about traffic in this context, we're not talking about cars or trucks on the road. We're talking about tankers carrying massive amounts of crude oil. These tankers have to navigate through the Strait of Hormuz every day. And if there's any disruption to their journey, whether it's due to a war, a natural disaster, or something else entirely, prices for oil can skyrocket. That's what happened back in 2019 when Iran shot down a U.S. drone that was monitoring its military activities. As a result, the Strait of Hormuz became closed off to shipping, and global oil supplies were severely impacted. Oil prices soared as countries scrambled to find alternative routes or stockpile more fuel. But now we're talking about something different. What happens when traffic resumes naturally? That's right, without any external intervention or conflict. The good news is that the Strait of Hormuz has reopened, and tankers are once again flowing through it at normal levels. And with this comes some pretty interesting implications for oil prices. In this video, we'll be breaking down what these implications mean and how they're going to affect you as a consumer. We'll explore why natural traffic in the Strait of Hormuz is actually good news, and whether or not it's enough to boost global economic growth. So let's dive in and find out more. As we discussed earlier, the Strait of Hormuz has been a critical choke point for global oil supplies, with over 20% of the world's crude oil passing through its waters every day. The strategic importance of this narrow waterway is undeniable, as it connects the Persian Gulf to the Arabian Sea and provides access to some of the largest oil reserves in the Middle East. The Strait of Hormuz has a long history dating back thousands of years, with ancient civilizations such as the Persians and Arabs using it for trade and commerce. However, its modern significance began taking shape during World War I, when Allied forces occupied the region to control access to the Persian Gulf's oil fields. In 1951, the British government signed a treaty with Iran that granted Britain the right to maintain military bases in the Strait of Hormuz as long as Iran agreed not to nationalize its own oil industry. This arrangement remained in place until the Iranian Revolution in 1979, when Ayatollah Khomeini took power and renounced all foreign influence over the region. In response, a new treaty was signed with the United States and other Western powers, which established the U.S. Fifth Fleet as a presence in the Strait of Hormuz. This move aimed to reassure regional allies that Washington would maintain its commitment to defending the area against potential threats from Iran or other hostile actors. Over time, these treaties have been renegotiated and updated several times, but their core provisions have remained relatively unchanged. Today, the United States maintains a significant military presence in the region through forces stationed at bases in Bahrain, Kuwait, and Qatar. The continued dominance of U.S. naval power in the Strait of Hormuz has contributed to its reputation as one of the most secure waterways for international shipping. However, with the recent resumption of natural traffic flow, we're seeing a shift away from this reliance on military might, at least when it comes to the oil industry, as tankers begin to traverse the strait once again without external intervention. It's clear that the dynamics are changing in some fascinating ways. As the Strait of Hormuz slowly returned to its natural state of operation, a new era began for the global energy market. The resumption of tanker traffic marked a significant shift away from the reliance on military escorts and diplomatic efforts that had dominated the region's dynamics for years. With this change came an opportunity for the oil industry to reevaluate its relationship with the strait. For many companies involved in the production, transportation, and refining of crude oil, the Strait of Hormuz was once a high-risk, high-reward environment. The threat of piracy and terrorism had necessitated costly security measures, which often drove up prices and reduced efficiency. However, as the situation normalized, these expenses could finally be factored out. The impact on the market was almost immediate. With fewer military escorts to contend with, oil companies were able to operate more freely, reducing costs and increasing their ability to compete in a global marketplace that had long been dominated by Middle Eastern producers. As this new reality took hold, traders began to reassess the fundamentals of oil supply and demand, looking for signs of growth or decline among major producers. Meanwhile, the United States, which had invested heavily in its military presence in the region as part of an effort to protect its interests, was forced to re-examine its priorities. With tensions easing between Washington and Tehran, policymakers were now faced with a different set of choices, ones that would have far-reaching implications for global energy policy and security. As the days turned into weeks, and the weeks into months, the effects of this shift in power dynamics began to manifest on oil markets. One major breakthrough came when Saudi Arabia, which had long been a dominant force in the region, announced plans to increase production levels by millions of barrels per day. This move was seen as a bold statement from Riyadh, signaling its willingness to adapt to changing global circumstances and shore up supply chains. The impact of this development was almost seismic, with oil prices plummeting as traders recalculated their estimates of demand versus supply. It wasn't long before other major producers followed suit, ramping up production levels in an effort to keep pace with the newly rejuvenated Saudi behemoth. The result was a veritable tidal wave of crude oil washing over markets, sending shockwaves through previously stagnant price structures. The rapid increase in global supply had far-reaching implications for energy markets as a whole. As prices plummeted and volatility subsided, traders began to reevaluate their investment strategies, seeking out new opportunities in emerging markets or alternative energy sources. Meanwhile, policymakers were forced to confront the reality that their carefully constructed security regimes might no longer be necessary, at least not in quite the same way. In Washington, officials scrambled to reassess priorities and adjust strategies accordingly. Diplomatic efforts between the United States and Iran were resurgent, with both sides seeking common ground on issues ranging from trade agreements to counterterrorism cooperation. As tensions eased, a new era of cooperation began to take shape, one that would have profound implications for global energy policy and security in years to come. With oil prices now firmly entrenched at levels not seen since the early 2010s, traders were beginning to breathe a collective sigh of relief. The storm had passed, leaving behind a tranquil sea of calm, but beneath the surface lay another set of challenges waiting to be addressed. As the market breathed a collective sigh of relief, concerns began to rise about the sudden drop in oil prices and its impact on producers. With revenues plummeting, many countries struggled to maintain their energy subsidies, leading to widespread protests and social unrest. In Saudi Arabia, for example, the government was forced to slash its budget by billions of dollars, sparking fears that the kingdom's ability to fund its war efforts would be severely impacted. Meanwhile, in Venezuela, a crisis deepened as Maduro's regime struggled to cope with the loss of revenue from oil exports. The public was also beginning to take notice, with many people expressing concerns about the long-term effects of low oil prices on the global economy. Economists warned that the sudden drop could lead to inflationary pressures and a decline in economic growth, while others pointed out that the shift towards alternative energy sources might be an opportunity for countries to diversify their economies. For those who had profited from the previous price surge, including some of the most influential traders on Wall Street, the situation was more personal. Many were facing significant losses, and some even saw their fortunes evaporate overnight. The experience served as a stark reminder that markets are inherently unpredictable and can change in an instant. The turning point came when OPEC nations finally began to discuss the possibility of production cuts to stabilize oil prices. It marked a shift from a business-as-usual approach towards one where cooperation was seen as a necessary evil to prevent chaos on the global energy stage. As negotiations heated up, it became clear that this new era of cooperation would be more complex and contentious than anyone had anticipated. As we reflect on the recent surge in oil prices and their subsequent drop after Hormuz traffic resumed naturally, it's essential to consider the legacy of this event. The dramatic price fluctuations serve as a reminder that global energy markets are inherently volatile and subject to unexpected disruptions. This is not only a testament to the complexity of international relations, but also highlights the critical role that geopolitics plays in shaping market trends. The impact of low oil prices on the global economy cannot be overstated. Economists warned about potential inflationary pressures, while others saw it as an opportunity for countries to diversify their economies and reduce dependence on fossil fuels. For those who had benefited from previous price surges, including influential traders, the sudden drop was a stark reminder of market unpredictability. In conclusion, this recent event underscores the interconnectedness of global energy markets and geopolitics. The turning point marked by OPEC nations' discussions about production cuts serves as a testament to the evolving landscape of international cooperation in the oil industry. As we move forward, it's crucial for countries and traders alike to remain vigilant and adapt to changing market dynamics. Ultimately, this story highlights the importance of understanding complex global systems and being prepared for unexpected events. By analyzing the intricacies of geopolitics and energy markets, we can gain valuable insights into the world around us and make more informed decisions about our investments and policies. The experience serves as a reminder that even in an era of unprecedented technological advancements, market uncertainty remains an inherent aspect of global commerce. Thank you. Goodbye.